Well, it's great to be here. It's my second time, and as you said, it's become really private capital. Private credit has become mainstream. We started 30 years ago ourselves. Back in 1996, the idea was that we're in the middle of all this deal making. We thought private equity would grow and become a much bigger force in the financing industry. And so the idea was, let's go and start lending to these borrowers, in particular owned by private equity. So we started in 1996, almost 30 years ago. In early 2008, we launched our first large cap senior direct lending funds. Yeah. And so yes, you can say we've been a bit of a veteran in the industry. We've been cycle tested, I would say, which is very good.
Yeah, let's look at where we are in the cycle, because clearly interest rates are at peak. Next step most likely is a cut, especially in Europe, but also most likely in the States. How is that affecting private lending?
Well, we try not to really focus on where we are in the cycle, right? I mean, we try to control what we can, which is, keep our underwriting discipline, try to focus on those companies that we think can weather any type of macroeconomic environment or cycle. That's how we assemble these portfolios over the last 28 years. So trying not to focus too much on the cycle.
But you must look at the macro environment and when you judge whether you hand out money or not. So how do you choose the industries at what point in time?
Historically, we focused on those industries that are more stable, more defensive, on those companies that have market-leading positions, are very cash flow generative. And hence, we're not really in the business of predicting the cycle, but we're trying to predict cash flow generation for the next few years and ensure that our companies can sustain those cycles.
Let's look perhaps as well at the question of what makes your lending different from bank lending. Are you charging higher fees? Because Steve was just saying that conference is called SuperReturn. So how is your return level?
Well, the returns historically have been attractive. Yes. But I would say, look, the solution that direct lending provides is very compelling for borrowers. Why is that? One, because we provide certainty. Certainty of pricing, certainty of documentation. It's a customized solution for the needs of the borrower. It's very bespoke. We can provide financing in almost any currency. We can provide acquisition facilities. Bear in mind, a lot of these companies are larger, market leading, and they grow through a lot of acquisitions as well. And I would say it's important for the borrowers, the management teams, to know their lenders, something that they do appreciate a lot when we speak to CEOs and CFOs. And so when you package all of it together, it is a very compelling solution, and hence why the direct lending has become an asset class and very much mainstream, as we can see here in Berlin today.
Deals, at least the level or the size of deals is coming, is a cyclical business. So are you seeing the comeback of super big deals?
We are. And if you look at the uptick in activity, certainly since last summer, 2023, we've seen it gradually quarter after quarter. We're getting into bigger transactions, multi-billion-dollar, which today is possible because a number of direct lenders together can speak for multi-billion financing, which was not necessarily the case 10 years ago. So absolutely, yes. I would say we also see the banks coming back and the BSL, the broadly syndicated market, coming back, which is great. A year ago, I was saying, when we see the BSL market come back, it's good because it means that the M&A market is slowly going back.